Zero DTE options. They expire the same day you buy them. YouTube is full of gurus telling you this is the fastest way to make money in the market. So I ran over 5,000 trades across every configuration I could test. Different deltas, different widths, puts versus calls, and every exit strategy you can think of. The result? Most configurations lost money, but 3 setups had a 100% win rate. Not 99, not 95, 100%. Here's exactly what worked and what didn't. For those new to zero DTE, you're trading options that expire today. You open and close the same day. The appeal is obvious. Theta decay is at maximum speed, so if you're selling premium, time is crushing value in your favor every second. But the risk is also extreme. One bad move and you're wiped out before you can react. I tested credit spreads, which are the most popular zero DTE strategy. You sell an option, buy a cheaper one for protection, and try to collect the premium before the close. The backtest, SPI as the underlying. 126 trading days from 2018 to 2023. That includes COVID, the 2022 bear market, and everything in between. I tested 3 deltas, 10, 16, and 20, 4 spread widths, $1, $2, $3, and $5, both put credit spreads and call credit spreads, and 4 management styles. No management, 50% profit target only, 200% stop loss only, and profit target plus stop loss combined. That's over 5,000 individual trades when you add it all up. Let's start with what lost money. Every single configuration that used a 200% stop loss combined with a 50% profit target lost money. Every single one. Put spreads with stops. Negative $65.95 at 20 delta, negative $4,832s at 16 delta, negative $3,211 at 10 delta. Call spreads with stops. Negative $6,409 at 20 delta, negative $5,000 at 16 delta, negative $2,074 at 10 delta. A combined $28,922 in losses across 6 configurations that every guru tells you to use. Here's why stop losses destroy zero DTE trades. Without the stop loss, all 1,026 trades at 20 delta hit the 50% profit target. Every single one. But when you add the 200% stop loss, 314 trades, that's 31% of all trades, got stopped out before they could reach the target. The intraday volatility spike triggers the stop, then the trade recovers by close. The stop loss is literally killing winning trades. On zero DTE, theta decay is so powerful that by end of day, even adverse moves get erased. A stop loss fights against your biggest edge. Now the winners. 3 configurations achieved a 100% win rate across 1,026 trades. Put credit spreads, 50% profit target, no stop, positive 14,443s with infinite profit factor. Call credit spreads, same setup, positive 14,067 and call credit spreads at 20 delta, $5 wide, 50% profit target, positive 16,964s. That last one is the single best zero DTE configuration I found. Let that sink in. Over $16,000 in profit, 0 losses, 126 trades. The equity curves tell the story perfectly. The green line is the best config, called 20 delta $5 wide with 50% profit target, straight up and to the right. The gold line is the same width with no management, still great at $11,857. And that red line at the bottom? That's what happens when you add a stop loss. From positive 16,964 to negative 6,409. A swing of 23,000 from removing one parameter. Calls beat puts at every delta. Without management, 10 delta calls made $5,049, while puts lost $1,421. 16 delta calls $79.62 versus $394. 20 delta calls $8,758 versus $1,692. A $6,500 earned to $7,500 difference just by choosing the right side. Why? The market has an upward bias over time. Call credit spreads are bearish. They collect higher premiums because of volatility skew. Those larger credits mean more profit per trade. And when the market grinds higher with occasional pullbacks, the call side benefits more from intraday theta crush. Width matters more than you think. For call credit spreads without management, $1 wide made $1,295, $2 wide $5,428, 3 wide 8758, a far wide 11,857. Wider spreads collect more premium and push your break even further away. The trade-off is capital at risk. A $5 wide spread risks 5 times more per trade than a $1 wide, but the profit is 9 times more. The risk-reward ratio improves dramatically as you go wider. Year-by-year breakdown of the best 3 configs. Call credit spreads were profitable every single year from 2019 to 2023. Yes, including the COVID crash in 2019-20. Yes, including the 2022 bear market. The only losing year was 2018, and even that was minor. This isn't a strategy that works in bull markets and dies in bear markets. Zero DTE theta decay doesn't care about direction. It cares about time. And on a zero DTE trade, time is always on the seller's side. 5 rules for zero DTE options. 1. Never use a stop loss with a profit target on zero DTE. It killed 31% of winning trades in our backtest. 2. Use a 50% profit target. Every single trade at 20 delta hit it. 3. Trade the call side, not the put side. Calls beat puts by $6,500 to $7,500 at every delta. 4. Go wider. $5 wide beats $1 wide by 9 to 1 in profit. 5. The best overall config is call credit spreads, 20 delta, $5 wide, 50% profit target. Positive $16,964 with a 100% win rate over 1,026 trades. Zero DTE options can work, but only if you follow the data, not the gurus. The fastest way to lose money is adding a stop loss to a strategy built on theta decay. If you want more backtests like this, subscribe and hit the bell. I test every strategy on real data so you don't have to lose money learning the hard way. Data doesn't lie. 5,000 trades. I first tested zero DTE for a viewer request. 100% win rate on zero DTE options. Stop losses killed 31% of winning zero DTE trades. Calls versus puts on zero DTE, $7,500 difference.